Hello and welcome to the Global View on this Wednesday. I'm Andrew Gagan. Good to have you with us here at AusBiz. Let's take a look at what happened overnight. And it was a late recovery of sorts on Wall Street, prompted in part by news that Ukraine has agreed to a ceasefire with Russia. That is yet to be taken to the Russians, though. But the recovery was not enough to turn markets positive, with investor sentiment dominated with concerns about an economic slowdown under President Trump's tariff policies. The S&P fell into correction during the session from its mid-February high as the president said he would double tariffs on all imported Canadian steel and aluminium products to 50%. Then, short time after that, in fact, we heard from an administration official who said that's not going to be the case. It'll be sitting at 25%. Now, Apple, the most valuable US company, slid, taking its 5-day losses to more than 6%. Tesla managed to reverse some of its recent losses, having tumbled around 15% the previous session, and Oracle fell after the cloud company missed quarterly revenue estimates. In the retail space, Coles plummeted after forecasting a bigger than expected drop in annual comparable sales, and Dick's Sporting Goods also fell after the retailer forecast downbeat annual results. In the travel space, Delta Airlines continued to lose altitude after the carrier slashed its first quarter profit estimates by half. American Airlines also slumping, having forecast a bigger than expected first quarter loss. A negative sentiment in the travel sector saw Airbnb among the worst performers as hotels, resorts and cruise lines all suffered. And Citi has become the latest broker to revise its stance on US stocks, downgrading its recommendation to neutral. Well, the United States has agreed to resume military aid and intelligence sharing with Ukraine after it said it would accept a US proposal for a 30-day ceasefire in its conflict with Russia. US Secretary of State Marco Rubio said the US would now take that offer to Russia. This was after President Trump continued to rattle markets by slapping an additional 25% tariffs on all US steel and aluminium imports from Canada, bringing the total of those tariffs to 50%, but then administration later saying that those hikes would no longer take effect. Meanwhile, Australia has failed in its bid for tariff exemptions on its aluminium and steel exports to the United States. Now, adding to concerns about tariffs, data showed US small business confidence dropped for a third straight month in February, wiping away much of the gains achieved after Trump's November election victory. The US 2-year Treasury yield rose to 3.93, the 10-year up to around 4.29%. Markets are pricing 0% chance that the Fed funds rate will be cut at next week's meeting, but a 40% chance by May. Investor attention now turning to inflation data due out tonight that could shed light on the future path of US rate cuts. The US dollar index is lower while the euro hit a 5-month high after Ukraine agreed to that 30-day ceasefire proposal. The Aussie trading at 63 US cents, and Bitcoin has recovered some of its recent losses to be trading around 83,000 US dollars. On the commodity front, prices broadly higher. Brent crude futures settling around 0.5% higher at $69 a barrel. Copper jumping more than 2.5%. Iron ore up 0.8% to 102 US dollars a tonne. And gold gained 1% amid a weaker dollar and an economic slowdown concern there. Spot gold at $2,917 an ounce. Well, let's get across the investment landscape globally. Elfreda Jonker joining us now from Alphinity Investment Management. Elfreda, good to see you again. It's been a while since we've had a chat. So much,
yes,
of course, has happened in that time. And I gather you and your colleagues at Alphinity have been travelling the globe looking for those investment opportunities. First, though, how would you describe what we're seeing in markets right now?
It certainly feels like carnage. But it really has become a bit of a headline market. So market is really reacting to any headline that's coming out from Trump or trade tariffs, regardless of what's happening with the underlying fundamentals of the various stocks. So it is a difficult market because you really have all asset classes sort of selling off and there's not really any place to hide. So it is definitely a bit of a tougher time to be in global equities, but I think the positive here is that a lot of the sell-off creates some new buying opportunities as well.
Yeah, the question is what strategy can you adopt in amidst so much uncertainty, particularly as far as those Trump policies are concerned. And, I mean, it's noticeable we're seeing those expensive stocks sold off, and clearly investors looking for value at this point.
Yes, I think over the last month of February, it's actually hard to think that the S&P 500 reached an all-time high just 3 weeks ago. And what you've seen in February is this really dramatic reversal out of growth into value companies. And sometimes it's justified and others not. But certainly the big swing out of the US, I think a lot of investors are still very much overweight the US from a global equity perspective. And then also, I think, underweight some of the emerging markets and European markets. So we do expect that this current sort of trend towards those markets to potentially persist for some time, particularly just given how volatile things are and uncertain things are in the US.
So, I mean, so often we've heard about US exceptionalism.
Yeah.
Is that now starting to falter, perhaps in terms of particularly market weighting? You want to be less exposed to the US and perhaps overweight elsewhere.
Yes, I definitely think we've already seen that. I think the market has already adjusted pretty quickly to that already. But I do think that we will probably continue to see that until there's a bit more certainty around what the implications are of these tariffs on growth as well as on inflation, and what the Fed can then do in response to that. So I do think, just talking to a lot of companies on the recent trips, as you've mentioned, we've been to Europe, US, India, and we've probably seen 100, 150 companies over that time across the 6 team members. And I think the general theme now, relative to when we saw them in December, has definitely moved from optimism to skepticism. And I think there's just a lot of frustration by management teams, because if you're not 100% sure that the current tariffs that we're talking about will continue, actually come through, you're not going to spend the money to change your supply chains or spend the money to adjust your labor force. So it's a little bit of a wait and see environment for corporates, and that in turn causes uncertainty, and then you're not going to get the earnings or the growth that you expect. And it's a bit of a big bad snowball effect, because it's not just the consumers, it's also the corporates that's now become uncertain. And then people stop spending, and you create this vicious cycle of lower growth. So definitely I think it's a time to look and find other opportunities that's probably trading at better values and probably outside of the US.
All right, so you mentioned Europe. We're seeing a ramp up in spending there, particularly with a focus on defence.
Yes.
So where are you looking at those opportunities?
Yes, so currently we have been adding some selective European companies over the last few months. I would say we have, and it's quite broad-based, because our approach is really trying to do that bottom-up stock selection, finding companies that's in an earnings upgrade cycle. And we've found that across a number of sectors, and that's the beauty of the process, is even if the whole sector is seeing downgrades, you can still find underlying companies that's up in upgrade mode. So some of the names that we've added, for example, is Richemont. That is a global luxury name. They are very diversified as far as the product, and they're more in the hard luxury space. And they're also a little bit of a play on China and potential recovery coming through out of China, where we're starting to see some green shoots. And other names would be CaixaBank, which is the biggest retail bank in Spain. We expect Spain to be the highest growth market in Europe this year. And that company particularly is going through a lot of strategic changes. So there's a lot of upside for us there for a stock that trades at less than 10 times PE. And then we've also added L'Oreal, for example, just to add that bit more defensiveness to the portfolio, where we have been reducing some of that growth and higher multiple type companies as in the AI space.
You mentioned China. You've been there, you're looking at those, the economy companies there. What are you seeing in China at the moment, particularly, I guess, with the prospect of more stimulus coming? But then, of course, you've got to weigh up that equation with the trade war that's developing with the US.
Yes, I think it is definitely a bit of a difficult time to assess what the long-term implications will be here. I think, firstly, I would say DeepSeek certainly did put China on the forefront of being an AI leader as well with the US. So that part of the market certainly has continued to rally. I think the other point that we would make is that China has really it's been a consumer confidence crisis, not necessarily, sort of the infrastructure type focus that we've previously had. So our expectation would be that we've already heard from the government now, and the package that they've announced, the 5% GDP growth, is probably more in line with what people expected, and it's not that big bang that we were hoping for. But we do think that whatever they're going to be doing now is to really focus on the consumer and continue to drive and improve that consumer confidence. Starting to see some green shoots, as I've mentioned. I think the key thing for them is they need to get property prices up, they need to get the equity market up, people will feel better about their balance sheets and then continue to spend from there. So that is sort of what we're looking at the moment across the board, but really also just companies like Richemont, for example, that's got 20 to 30% of their sales linked to the Chinese consumer, that will hopefully benefit from that sort of trend without being just exposed to China.
And what opportunity are you seeing in the world's most populous country, in India?
Yeah, so India was a fascinating trip. I think it was very clear from the feedback from our team that India's growth path is there and it's going to accelerate. And I think if you think back pre-DeepSeek, it was probably India's the new China. I think that narrative has probably changed a little bit over the last while, but certainly for us, we are not directly invested in India, but we have companies like L'Oreal, for example, a global conglomerate staples with quite a bit of exposure to that market, where obviously that population growth is really high. The number of people that's increasing in that sort of higher consumer spend bracket, that's also sort of going up in combination with overall population growth, which is exactly opposite to what you have in China. So for the moment, not direct exposure there, but we are definitely looking at opportunities, but it's probably more indirect, but certainly a market that we want to have exposure to.
Elfreda, great to get your outlook. Thanks for joining us from Alphinity Investment Management.
Thank you.
Let's refocus now on the local market. We're expecting another deeply negative day. SPI futures off almost 1%. And we're going to get right across that when markets open in just a couple of minutes' time.